All right, so welcome to Finance 231, week 2. This week is a midterm week, so we'll be covering the midterm for the last 10 or 15 minutes of the class tonight. Make sure that you understand the topics that you need to understand for the midterm. The midterm is comprehensive. It does cover chapters 1 through 2 from week 1 and chapters 3 through 4, which will be tonight's content or this week's content. I've already posted the slides for for chapters 3 and 4, and I'll be, of course, posting tonight's recorded session a little bit later tonight as well. I've got all the grading done except the discussion boards, and I'll have those graded tonight. Just as a reminder, I'll have everything graded every week that's turned in on time by Wednesday at noon. That's school policy. I usually get things done by Monday night, though, so you should see on-time work graded by Monday night. Now, as far as late work is concerned, I just get at it when I can get at it. So if you see something sitting for a while that you've turned in late, you're welcome to zip me an email just to make sure, and direct my attention to it. But there's no guarantees on the timing for the grading on late work at all. Many of you tonight will see some feedback on the assignment as far as how you did on it, what kinds of things you could do to improve. And like we discussed last week, keep in mind that you are able, of course, to resubmit your assignment for additional points. If you didn't get full credit and you can see something that you're able to improve your assignment by doing, you're welcome to resubmit it, and I'll award additional points if I can based on your additional efforts. Okay? So that's just something to keep in mind. It's always a good idea to review the feedback on the grading on the score so that you can see if there's some way that you can improve your score and get a better grade. Hopefully all of you are on track as far as checkpoints are concerned. Just a quick reminder that that's the easiest way to get points in a class like that. That in addition, and also the discussion board. Having said that, I posted an announcement maybe yesterday or the day before regarding the discussion boards. I could see as I was going in to make comments on a lot of your posts that there's probably going to be a situation where many of you won't get full points on the discussion board. And of course, I haven't graded them yet, but I'm just guessing that this will be the case because I was seeing a lot of very short posts. And just as a reminder, there is a content requirement that the school puts forth. I don't have anything to do with that, but I do have to follow and abide by what they've set forth. And so if there's a content requirement to have a certain amount of words and you've got a third of the words that are required, so 2/3 less than the requirement, I can't give you full credit for that. If you're close, then I can give you full credit. But if you're way off, as far as much shorter than what the requirement should be, then I can't give it to you. Another example is on the responses. If you give a one-line response, I can't give you full credit for the response. Those responses need to be, 3 or 4 sentences. They need to be substantive. They need to be, they need to evidence the fact that you've thought through what you're saying a little bit more than just reacting and saying, hey, great job. Now, having said that, and I'm pretty sure I mentioned this last week, but you may get distracted by the fact that my responses as the professor or the instructor on the course are short. Many times they're short, and that's just due to the fact that I have to post 20 to 30 times a week. If you'd like to post 20 or 30 times, you're welcome to, and I'll give you full credit, even if they are shorter for responses. But if you're only going to post the 2 or 3 responses required, then make sure that you've got the content requirement so I can give you full credit, okay? So for those of you who do not get awarded full credit for your discussion board, once again, just like the assignment, be aware that you can go in and edit your discussion board comments, add additional content, and if you'll do that, then I can give you some additional points. But keep it in mind for this week as you go through the discussion board for this week. And this week's discussion board, we're talking about automated investing or investing online through the internet. As you react or as you create your main post this week, be sure to just briefly review what those content requirements are so that you have a better idea of what we need to get full credit, okay? Because I think discussion boards are one of those places where you can get some very easy points, but we still need to follow the basic guidelines associated with discussion boards so I can award you full credit each week. All right. Any questions from last week? Looked like overall that most of you did a good job on the test. I don't know, Scotty, how it was for you, the test in week 1, but most of you did very well on the test, so I appreciate that. That's always exciting for me. Sometimes the tests in this class are tricky, so when I see really good scores on the test, I get excited. Average score was very good, so good work in week 1 on the test. If you struggled with week 1 test, just be careful. The week 2 test does review all the material from week 1 again. So as I mentioned, the week 2 is considered a comprehensive midterm, and so it's covering all the material from the week 1 test as well. So Scotty, you should be in great shape because, as I mentioned, you'll see a lot of repeat questions on the week 2 test. April, welcome to class tonight. Thanks for coming, and we're just talking about last week's work, and then we were talking a little bit about what this week's expectations are. Had some issues I wanted to point out as far as the discussion board from last week. I felt like a lot of the comments were really, really light of the writing requirement. So I can't award full credit if we're not even close to the minimum expectation there. So just I guess a caution for future weeks to make sure that we get closer to that content requirement that the school has put forth for the discussion board. And I'll give you some feedback on your discussion board comments. I haven't graded them yet. I've graded the assignments and assessments, but I'll give you some discussion board feedback tonight. And if part of that feedback is that you don't have enough content, you are welcome to go back in and edit your discussion board comments in order to accomplish some better points. Okay? All right, one last thing, just as a reminder for those of you who may have forgotten from last week already, I do accept late work. So if you find yourself at this point already behind, missing an assignment, missing the test, missing the discussion board comment or comments, you are welcome to still go back and complete those for week 1. It will not be for full credit. I can't give you an 100% if you turn things in late, but I can give you a majority of the credit. So please, please, please don't give up on assignments or assessments or discussion boards that you haven't turned in on time. Go back in, complete them, and I'll be able to award you some of the points. Okay? I just reminded myself that I need to go back in and change the dates on the tests. So let me make a quick note to myself so I can go ahead and do that after class. While I'm making that note, any questions, concerns for this week or last week as far as the coursework so far? Okay, so we're all feeling okay at this point? All right, so this week, for the assignment, I'm not going to spend time during this class on the assignment. And the reason I'm not is because I have pre-recorded from a few weeks ago on a different mod, but it's the same class. I've pre-recorded a little bit of a tutorial for this week's assignment. And if prior to today you had printed off the instructions for the assignment, I would encourage you to go back as I have edited those instructions as of today. So please, if you've already looked at them, go look at them again and take note this time because those instructions have been updated. This week's assignment has the potential to get you very frustrated with the math part. So parts A and B on the case study are a lot of math. So, but before you get intimidated by all the math, know that if you just input the right formulas into Excel, you can just input the data and it can be very simple. It can be a very simple process. Now, I don't want to make light of the fact that it will probably take some time though. So I would strongly encourage you all to get an early start on the assignment this week. And if it were me, before I would look at completing the assignment, I would read through what the assignment is asking for. Okay, as far as the holding period return calculations and standard deviation calculations. And then I would go to chapter 4, which is where the content is found. The information is found about solving for holding period returns and standard deviations. I would read through the content that's applicable to those problems. And then I would also be very careful to listen or watch the YouTube recording that I've already posted on the announcement board for kind of a tutorial on the week 2 assignment. I say that, and I usually don't, have a special, recording for the assignment, and I usually don't, tell you to get an early start, even though that's a good practice no matter what the assignment is. The reason I say this is because I've taught this course probably 20 or 30 times. And this assignment tends to trip people up pretty significantly. And a lot of times I'm guessing that it's because they didn't put in the effort early on in the week. Because this is the kind of assignment that if you get to it Saturday night late and you're thinking, I'll just get in there and spend a half an hour or an hour on it and I'll be good, probably going to trip you up, and it's probably going to be a very stressful experience. So I would just get an early start on it. Get with Lindsay Hawes, the tutor, if you feel like you really just don't know what to do, even after you've listened to my tutorial that I've posted on YouTube, that the link is on the announcement board. And if you've read through the chapter on the material that's applicable to this week's assignment, still feel lost after the session, after the chapter, after trying your best on it, then maybe arrange a time with Lindsay or zip me a quick email on the particular part that you're getting caught up on. And it always helps me if you will send me what you've done or how you've set it up so far. So it's a lot easier if you put some effort into it. If I can tell that you haven't put any effort into it and you're hoping for some free answers, unfortunately, I'll encourage you to go back to the book or back to the tutorial session or back to the formulas, to re-review before asking questions. Okay? So that's this week's assignment. I don't mean to scare anybody. I don't mean to get you intimidated by it, but I would like to make sure that everybody's clear that I encouraged you early this week to start on the assignment, and I encouraged you to get help if needed, and I encouraged you to do, to really review that tutorial that I've posted along with the Chapter 4 material so that you don't get completely caught off guard Saturday night and just kind of not know how to complete it and then give up on it. Okay? I don't want you to give up on it. Please let me know if you get stuck, but let's put some effort into it early this week. I know, Scotty and April, you probably haven't even looked at the assignment yet, but any questions about the assignment, maybe general questions that I can answer before we proceed with the material tonight? Did I scare you, or are you feeling okay? I wasn't trying to scare you. I just wanted to make sure that you feel comfortable with what you need to do. All right. Okay, so tonight we're going to look at Chapter 3 and Chapter 4. Chapter 3 talks about how we acquire information about investments. And then Chapter 4 talks about risk and return and that risk-return trade-off that's so critical and so important to investing. Everything about investing decision-making comes down to risk-reward. And one of the things we talked about last week is how cost-benefit analysis, if you're a business manager, is very similar. Okay. In fact, it's almost identical, but it's very similar with a few minor nuances to the risk-reward trade-off and the risk-reward analysis that we're doing when it comes to investing. Okay. Cost-benefit analysis, just analyzing benefits versus costs and making sure that you're going to profit, in the end. Risk-reward is analyzing risks associated with an investment, potential pitfalls of an investment, and then the potential returns of an investment, and making sure that you understand the risks and making sure that you're getting fairly rewarded for the amount of risk that you're taking. So that's risk-reward. We probably won't have a lot of time to talk about risk-reward tonight if I were to guess, but hopefully we'll get to some of that content. Now, Scotty, as far as the math on the assignment, sorry, I missed your comment. It could be a little bit confusing. The best thing that I can tell you to do, as I've said a few times, is review that recorded session that I've got, that recorded tutorial that I've got posted on the announcement board, and then spend some time looking at the actual problem examples within the text in Chapter 4. Because Chapter 4, it's an end of chapter scenario, right, that you're answering for the week 2 assignment. Chapter 4 inside the chapter has examples that are almost identical to the example that we're doing as the case study. Now, the material's not the same as far as the actual numbers, right? But as far as how you set it up to calculate holding period returns and then the average holding period return and then the standard deviations, all that as far as the setup and the equations are going to be identical. So spend some time in Chapter 4 looking at holding period returns and standard deviation calculations so you'll be in good shape. Okay? All right. Okay, so let's look at investment information. Now, this correlates very well to what we're looking at when it comes to this week's discussion board. So this week's discussion board, as we've mentioned earlier, talks about whether or not you all feel comfortable investing online or taking advice online. And reality is most of the information nowadays that we obtain regarding different companies that's timely happens online. Okay, so you can wait for the Wall Street Journal, which the information in the Wall Street Journal is usually a day late at least, right? By the time you get it, by the time they print, by the time you receive it. Online, you can get information live time. So a few days ago, there's a company in Utah called Profire Energy. Profire is in Linden, Utah, and they specialize in parts, okay, parts for oil wells, okay. So an oil well is operational. They'll come to a company like Profire and they get some different components for their oil well. And these components cost quite a bit. And maybe you all know oil has struggled, oil companies have struggled the past year because oil prices have been very low. So the point of all this is that if I'm an investor of Profire and they come out with their earnings, okay, they come out what their sales were, they talk about their company. When they did that, the stock price dropped considerably, was fairly poor, meaning they expect sales to be fairly low, they expect profit to be almost. Kind of information makes investors obviously want to sell the stock. You can find that information immediately when it's disseminated online. Phone call, those types of things take time, right? Information gathering. It's a very accurate tool online. If you go to sites that are not reputable, it's not credible, okay, or not accurate. MSN Money, Google Finance, Yahoo Finance, they're very mainstream sites, and they publish information. They are quick in most cases to update or to ensure that it's accurate at any given point. Okay, so these types of sites for you and I as potential investors. InvestorGuide.com, the Motley require you to have subscription services for. Most of them will give you some basic information and you've probably already seen them as you've done different research, like Investopedia.com. Investopedia of information on different elements of investments. Investopedia is a great polling with the case study for Dana, short selling a stock. Look up short selling and kind of how you can use it. So that's as far as financial concepts or sites like bankrate.com, things you can use, but even sites like Fidelity, some good educational information and tools as well. Sites like mint.com, that's mint.com, finances, helps you to budget and do other things as well. It's a free site. A site like Credit Karma, CREDIT, credit, how you'd normally spell it, then Karma, to review some different things as it relates to your credit scores, credit information, and then different sites that can help us with basic information. One of the things that I want us to hone in on or focus on, though, this week on the discussion board are sites that potentially give for you to do financial planning, okay? So there's lots of investment information sites and actually give you advice and invest for you. So that's where I'd like to focus a little bit more of our time and effort this week on why you are or are not comfortable. I wanted to point out this site. This is a great tool for all of you when it comes to investing. It's is a financial services or financial industry website that's watchdog of the financial profession. FINRA is this organization. So in the United States, the SEC responsibility of carrying out compliance, right? Of being kind of the police force when it's staffed, and there's no way that they could keep their eye and be a watchdog for all. So FINRA is an industry organization of volunteers that volunteer to basically help each. They actually can disbar people from practicing investments. So they have some power, but really their main priority is to help the industry be trusted, right? The whole purpose of FINRA is to help within the industry. They're anxious to make sure that person gets out, right? And whatever they need to do as far as, well, because that's the goal of FINRA, to help you and I as consumers of investment products to trust as an example of what their site looks like, that has lots of different tools and information regarding investing. Okay, there's no products to be sold on this site. Most sites you do go to are trying to sell, but the point is this site isn't trying to sell you anything. It's just trying to get you important information. A site like finra.org when you're researching, what to do. Another just quick tool that I like to point out on this one is the FINRA broker check products. You are able to do a FINRA broker check and just put that person's name, licensing, and whether or not they have a history of lawsuits or people complaining about them as advisors. Okay, so it's basically a one place stop legitimacy of the person that you're about to potentially work with when it comes to investing. Okay, so that's a nice tool. Zacks is a good site. You can see different financial websites that are legitimate. So there's lots of pros and cons of information when it comes to the internet, because this is this week's discussion board. Well, we've got two basic types of information when it comes to investing. We've got descriptive information and analytical information. The descriptive information, an example, financials, which if you're a publicly traded company, you have to publish your financials on a quarterly basis. It's like Google Finance and MSN Money and Yahoo Finance. They'll immediately publish those. That would be descriptive information. It's just eliminating that information without adding any kind of feedback with it. They're just giving you the information. And it's taking that descriptive information like financials and then interpreting the financials, then analytical information. An example of that would be both the income statement and the balance sheet. A company is a good investment on higher than where that's due with will be a pay for service. Because the people who are giving that information are having to spend time, effort, and energy, and the company who sponsors it a pay for service associated with analytical information. Another way to get to actually have a online trading account with a company like E-Trade or Ameritrade or Scottrade or Fidelity or Vanguard. There are lots of different, and almost always when you invest with these companies, they then allow you access to pay for services, but you get free as a customer of their websites for trading. Okay, so that's if I were thinking about investing in stocks, instead of paying for an analytical service, and this is just me, instead of paying for and then access for free the analytical information that they can provide me. Okay. All right. Gives you lots of different examples of ways to collect current investment information on the economy. Lots of different information. Graphically, talked about Yahoo Finance, but here's a few others. Many times we'll look at Yahoo Finance together, myself and the client, because graphically, Yahoo Finance does a good job with graphically what that particular investment has done over time. It also gives the client an opportunity to see that this is information that they can actually look up on their own, right? So information on a mobile app on their phone at any point they want, or at home on their PC or laptop at any point, free. Here's some more publications, more industry information. So you can find price information very easily. Easiest way I can tell you to find price information, because most of us use Google, either a symbol or type in a company name and put stock after it, and it will show us, usually it'll go right to a chart, and then a link underneath the chart that'll link us to Yahoo Finance or Google Finance or MSN Money, so that we can take that company and then find out more information about the company. If you just put in, in a Google search bar, for example, Coke stock, okay, Coke stock, it will tell you that the symbol for Coke is K, just the letter K, and it'll show you a chart, and it'll give you some links to different sites to find out additional information. So for me personally, Google's the easiest way to research companies. I don't even need the stock symbol, because I can just put the company name and then stock after it, and usually, about 99% of the time will get me right to what I'm looking for. Here are some examples of different symbols for different companies. See, some of them make a lot of sense, like Target, TGT. Some of them make no sense at all, like Sears Holding Company, SHLD. Most people would not equate that to Sears. Or a company like Yahoo is pretty easy, right? Walmart, UPS, those all look like the company they are. And then there's companies like Coke and AT&T that don't make a lot of sense at all, right? KO is the symbol for Coke, and T, just the letter T, for AT&T. Most people wouldn't guess that one either, right? But as I mentioned, it's very easy to look these symbols up just by Googling the company name and then stock afterward, and it'll take you right to the symbol, okay? Okay, this should go without saying, but obviously we all need to be very careful when it comes to investing online that we don't get scammed. Many times in past classes, this becomes the focus of, the discussion board for this week when we talk about online investing. Everybody's, main consideration when it comes to online investing is the fact that you might get scammed out of your money. I would tell you, in the 12 years that I've been around the investment world, and been a full-time financial advisor, and in the 2 or 3 years prior to that, that I was just a consumer of investments. I just went online and did investments on my own. I have yet to see through a legitimate site someone get defrauded or scammed when it comes to investing, okay? And I have talked to thousands of people over the past 12 years, as a financial advisor. I have, however, seen many people get defrauded, okay, via phishing scams online, via their email. I've seen a lot of people get defrauded by solicitations, for investing. If you want to avoid the potential for that, just use a legitimate site. And you might say, well, I don't know what a legitimate site is. And I would tell you, do some research. It's very easy to get third-party, independent information from a website like CNBC or MSN Money on some of the best websites for online investments. Okay, And if you go to one of their sites and find a list of different online investing platforms, and then you do your own research on those platforms, just researching one to another, how much the minimums are, how much they charge per trade, things like that, you will be just fine investing online. You'll be safe and secure. Take a little bit of research, does take a little bit of time. It's not a lot of time, but it does take a little bit of effort in order to find some legitimate sites. But I can tell you right now, a site like Ameritrade or E-Trade or Schwab or Fidelity or Vanguard, those are all very legitimate online trading platforms for investing, and you would not go wrong as far as being scammed or defrauded or shysted. You're not going to have any of the risk associated with being scammed from any of those sites that I just mentioned. Now, if you go on your own and just respond to an online solicitation or a junk mail, that comes in for investing, or a site that looks kind of hokey and you've never heard or read about it in your entire life, then you're putting yourself at risk, right? And we should never entrust sites like those or emails like those with our money. That's pretty straightforward, pretty simple. That's just basic online, diligence, right? So shouldn't be any surprise to you that I'm suggesting that you do some basic research before you invest somewhere and put your money somewhere online. That should be how you do anything online, right? You shouldn't just take the first site that you see. You should do some research and make sure that you've got a good one. Any questions, Scotty or April, about what we've covered so far as information when it comes to investing? All right, so just some basic questions you can ask. I'm not going to go through them, but things to think about before you use an investment tool, either online or in person. Good questions to ask. I think this is an important concept, and so I'm going to spend just a few minutes on indexes. One of the things that a lot of people get hung up on stocks is that they feel like it's going to be too hard to understand. And one of the reasons they feel like it's going to be too hard to understand is they always are hearing somebody on the news, on the radio, or on the TV, or in the newspaper talking about the Dow Jones going up, or the S&P 500 going up, or the NASDAQ going up or going down. And they think, I don't even know what that means. I don't even know what that is. And so let's talk a little bit about what these are, so that next time you hear, hey, the Dow Jones went up 10 points, what does that mean even? Why do we even care what happens to the Dow Jones? The Dow Jones is a small index of only 30 companies, but they're large companies and they're diversified companies. And so historically, that index, the Dow Jones, has been a good indicator of the overall market direction. So if the Dow Jones goes up, it's pretty likely that your stocks, if you've got a basket of diversified stocks, went up that day as well, or your mutual funds went up that day as well. So the Dow Jones is just a good indicator of where the market overall is going, even though it's a very small index. And what do we mean by it going up 10 points? It just means that the 30 stocks inside, moving all different directions, equated to a 10-point move, and perhaps more easily to understand, a certain percentage increase, okay, or a percentage decrease. And that percentage increase or decrease helps you understand how far the market moved that day, up or down. Okay, so that's the Dow Jones. The S&P 500 is just 500 of the largest companies in the United States. It's actually 501 now. This slide is incorrect. I always like to prove slides that the textbook people have made wrong. That's always fun, but it's 501 stocks now. And we still call it the S&P 500, though, because it's an index that was created years ago, and we don't want to confuse people by making it the S&P 501 now. Okay, it is still 500 companies, but it's 501 different stocks. All right, which is kind of confusing, but one company in the S&P 500 actually has two different stock issuances that are available. Okay. Anyway, the point is the S&P 500 is a more broadly diversified index because it covers more companies, right? So if I were to ask you between the S&P 500 or the Dow Jones, which one usually would be more accurate or a better representation of really what happened in the market, your answer would be the S&P 500 would be a more accurate indicator because it just represents a more broad-based cross-section of the economy. Okay, instead of 30 companies, it's 501 stocks or 500 companies. And then the NASDAQ is a smaller one. It represents more companies, though, just a lot of smaller companies can be listed on the NASDAQ, and it tends to be overweighted to financials and technology. So when technology is doing really well and the financials like banks are doing really well, the NASDAQ tends to be overweighted to those two, so it will go up a little more so when those are doing well. Okay, so those are the main indexes that you'll hear on the news, so I wanted to mention those. Then you've got some other indexes like the Russell 2000, the Russell 1000, the Wilshire 5000. The Wilshire 5000 is probably the biggest index that's available out there. And of course, if you really wanted an index that covers all your basis and really indicates what the real market is doing, that Wilshire index is probably the most comprehensive one. It's just not very widely used because historically, the Dow and the S&P are good indicators. Okay, and since they're not broke, we're not looking to create new indexes and bigger indexes or report on them, because so far the Dow and the S&P have served us well as far as being indicators of where the market's going. All right, so this is just an interesting piece, although I don't like it a lot because it doesn't cover 2008, which was a huge market downturn, as you recall. But it does show 2011 it going down. But the point overall is that the S&P and the Dow move very similarly to each other, as you can tell by this chart. Usually when one moves down, the other moves down, and usually when one moves up, the other moves up, right? That green and black line, they follow each other pretty closely. And you can also see by looking at this that the market is always bumping around, right? It's moving up and down. And for some people, that's acceptable. They can accept the fluctuation. For other people, that's just the worst thing ever. They hate it, and they don't invest in the stock market because they don't want their balance to go up and down. Having said that, the stock market overall, and if you don't believe me, just go do the research. The stock market overall over the last 80 years is one of the best investments that you could have ever made, because the market has averaged long-term over 8% returns, compounded, which means that you double your money every 9 years in the stock market on average. And even though we've had some very bad years, like 2008, 2001, when 9/11 occurred, 2008, the financial crisis, go back to 87, it was a really bad year. There's lots of years that we can point to and say that was a horrible year for the market. Even though we've had those horrible years, the overall direction of the stock market has been positive and has been a good trajectory and a great investment for people long term. Now, sometimes the stock market is not a good investment short term, right? But at least historically, the stock market has always been a very good long term investment. Okay? Let's see. I'm not going to talk about stockbrokers. Let's go ahead and skip to chapter 4 for just a minute to kind of set the stage. We don't have a lot of time to cover in great detail, but at least we can kind of set the stage for that very important concept, as we mentioned when we talk about risk reward. Just trying to pull it up here. All right. So April, Scotty, can you see the chapter 4 return and risk before I just changed it? All right. So you recall from last week that we talked about return. And return, when we talk about total return, was the combination of both value change and interest or income that we could potentially get. Okay, so keep that in mind. When we talk about total return, we're talking about both income that we can receive in the form of interest or dividends and value change that we can receive in the form of the actual share price going up or down. Okay, and value can be down, right? I mean, I can invest in a stock at $100 and it could go down to 50. So my value change was negative 50. But let's say I got $2 in dividends. So my total return would have been negative $48. Does that make sense? So I got negative 50 in value change. I got a positive 2 in dividends. And the combination between a positive 2 and a negative 50 is negative 48, right? Just simple math. So that's my holding period return in a year if the stock went from 100 down to 50 and if it paid me $2 in dividends. Still a horrible investment, right? Even though I got some dividends, I still lost a bunch of money. Other times, I'll have a situation where if I'm in a bond portfolio, I might go up $2, in share price, and I might also get $2 in dividends for a total of $4 total. So if I started at 100, it went up to 102, plus I got $2 in dividends. That means that my total return was up $4, which means that I got a 4% return. Even though the value only changed by $2, my total return includes both value and interest, as we've discussed. Okay, so that's an important concept, because this week's assignment, part A, is all about calculating holding period return. And the way you calculate a holding period return is you take the value change, negative or positive, you add it to the dividend, and then you divide by the beginning value. Okay, so if a stock began at $100, you would be dividing the change in value plus the dividend divided by the beginning value, in this case of 100. Okay, not the ending value, but the beginning value is what you divide by. That gives you the percentage holding period return for a year, for example. Okay, and you'll be doing 10 of those calculations for part A on stock X and 10 more for stock Y. So in total, on part A for the assignment this week, you're going to be doing 20 calculations for holding period returns. But before you get sick to your stomach or feel like that's just crazy, you're having to do 20 problems, keep in mind that all you're doing is a simple addition and then division problem, right? You add value plus dividend, divide by beginning value, and that gives you your answer. So it's pretty easy to come up with that holding period return. And so doing 20 of those is not going to be a big challenge for this week's assignment. The return is just a way for us to keep score, right? The idea is, if we learned in week 1 that in order to be an investment, even to be characterized or described as an investment, by definition, it must have some kind of return. Now, it might not have value change, but it would have to have interest in, right? It would have to have income. And it might not have income, but then it would have to have value change potential. If it doesn't have either, then it's not an investment, right? And if I think that the potential for return is negative, right, that it's going to go down, then I should not invest, right? Because the whole idea of investing is that you have the expectation that you'll get a positive return, whether it be through interest income, value change, or a combination of interest income and value change, okay, for your total return. So I think this is an interesting graphic. I'll leave with this one, and we'll go to what we need to know for the test this week. But this gives you some insight into some different countries, okay, the U.S. included, listed there at the bottom, but some different countries on how they've done as far as inflation, government bonds, and then the stock market over the past 111 years. Okay, so this is a long time of history that it's looking at. So just looking at that 111 years, which country did the best as far as their stocks are concerned? Which country did the best as far as their stocks are concerned? So look in the left column. Scotty, that was quick. Good job. Finland has had the highest average return in their stock market, okay, over the past 111 years at a whopping 12.6%, which means that you would double your money, okay, every 6 years in their stock market over the past 111 years. You double every 6 years. Now, the flip side is, if we were to minus their inflation rate over the past 111 years, their net rate of return would actually be less, okay, their real rate of return would actually be less than the US real rate of return, okay? Even though they started higher, the average inflation rate in the United States has been much lower, 2.9% over the last 111 years, than most every other country, but specifically Finland has had a very high 7.2% inflation rate. So how do you find out the real return on your stocks? You minus out the inflation rate from the stock return, okay? So for Finland, that gives you about 5.4% real return that you've gotten from their stock market when you less out inflation. Does that make sense, or have I lost you all? Okay. So then if you go to the United States, we start at 9.3% average, you minus out the 2.9, and you get to 6.4%. So approximately 1% more on average per year in real return in the US stock market versus Finland's stock market. Even though Finland looks like they gave you a lot more in return on their stock market, when you take out the fact that inflation was much higher, okay, and devaluing the value of their investments over that period, the US stock market was superior. Okay. And I mentioned earlier, you're getting a significant return by being a long-term investor in the stock market. This bears that out. If you look at that left column, every major economy of the world has had a significant return on your investments when it comes to the stock market. It's been a very good investment. Because of time value of money, obviously the sooner you start investing, the better potential that you'll have as far as the return in the long term. That just goes back to that basic finance principle of compounding interest and time value of money, that time value of money works because interest starts to compound and pay on itself. So if I have a 10% return on $100, I get $10 of interest this year, but next year I get $11 of interest. And that interest amount just keeps going up every single year and compounds. And the longer you've got, especially really long term, like 20 or 30 years out, that makes a substantial difference to have that compounding rate of return working for you over the long term. Okay? All right, so those are just some basic concepts I want to throw out there before we get to tonight's final item, which is that we need to make sure that we understand the concepts that will be on this week's assessment. This week's assessment is 20 problems. It's worth 100 points, which is double what the week 1 assessment was at 50. Okay. It is still just true, false, and multiple choice. And I will just say that for problems 1 through 10, so for the first half of the test, you are going to be very delighted to find out that problems 1 through 10 are almost identical, if not identical, to the week 1 test. Okay. So if you've got your notes from week 1, great. If not, I would review them briefly, both the notes and then the chapters, so that you feel comfortable, but you'll recognize the problem. So hopefully you took a few minutes last week when you got your test results, and that will help you, to score well on this week's test as well, because the first 10, as I mentioned, first 10 questions are all repeat questions from week 1. I'm not going to specifically go over those topics. You can go back to the week 1 session and do so, or your notes, your specific notes from that. All right, number 11 on the test, okay? And these are the topics that you'll need to know for this week's test. Number 11 on the test asks you about live brokers, so stock brokers. Do they charge more or less than online trades, as a general rule? So you'll want to find out before you get to the test this week whether or not a live broker, someone like myself who can trade stocks for you, whether or not I would charge you more or less if you were to call in a sale order to me or a buy order to me by phone than if you were to just accomplish it online by yourself. Okay? So that's number 11 on the test. Number 12 on the test talks about, you'll need to know what the book has to say about the advantages and disadvantages of online trading. Okay, advantages and disadvantages of online trading. That will help you to get number 12 right on the test. Number 13 on the test asks you to demonstrate that you understand the difference between descriptive information online and analytical information online. Remember, we talked about descriptive information, and I told you that you do not need a subscription service for descriptive information. It's very easy to access that information at many different websites, and we talked about some of those examples. Analytical information is the type of information that many times will require a subscription service. Okay? If you know that, you'll get number 13 on the test right. Number 14 on the test is basically asking if you can analyze and develop strategic plans and financial planning through online sources. Okay, so we know we can trade online, but make sure you know what the book says about whether or not you can develop planning and set goals and strategies online. Number 15 on the test, make sure you understand the concept of the finality of an order. And what do I mean by that? I mean, the finality of an order is that if you put in an order online to trade and you click the button submit and then you click the button confirm, in that very moment you have made that trade and there is no way for you to then rescind that trade. Okay? Meaning there's no room for error once you've confirmed your trade. That's why most sites will have you submit your order, then they'll have you confirm it before it'll actually take place, just to double check that it's correct. Because if you put it in wrong, there's no way to go back on it other than to go back in and just make a trade that offsets it. So for example, if I put in a trade on accident for Apple and I meant to put it in for Microsoft, okay, I would have to go back in. If I had traded Apple and bought into Apple when I meant to do Microsoft, I would have to sell my Apple stock that I just barely bought and pay a commission to do it. And then I'd have to then put in my purchase order for Microsoft stock after. Okay, so it's a very costly mistake when you're paying every single time you trade to put in a wrong order. So it's something you got to be real careful about, and it's something that websites help us with because they, like I say, you enter in your order, you submit it, and then they give you a confirmation page so that you can double check that your information is accurate. Number 16 on the test, you'll want to understand for 16 what the difference is between a stated rate of return and the true rate of return as far as interest rates are concerned. So what is the difference between stated rates and true interest rates, or effective annual rates is another way to say true interest rates. So I need to know that for number 16. Number 17, make sure you understand what we mean, what the terminology discount rate is. So make sure you can define what a discount rate is. Number 18 on the test, once again talking about discount rates. Make sure you understand that discount rates take into effect present value and time value of money. Discount rate is taking into perspective time value of money and a present value for future benefits and costs. Number 19 on the test is we'll ask you to understand required rates of return. Why is it that required rates of return go up and down? Why at one point might we require that we get a 5% return and then 10 years later we might only require 2% returns? What impacts the required rate of return when we're talking about interest and returns for our investments? So make sure you understand what the book has to say in Chapter 4 about required rates of return. And number 20 on the test. Number 20 on the test just basically is going to ask that you understand the different keys to a return, okay? So there are all kinds of different internal and external things, and we didn't really cover them in detail tonight. I just skipped right over those slides. But there are different reasons, both internal and external, for a stock's return, for a stock going up or a stock going down, both internal and external reasons. You'll want to read through and you don't need an in-depth knowledge, but just have a basic understanding of what those basic reasons are for a stock going up or down, and you'll be in good shape for number 20 on the test. Okay? All right, any questions about that content or the topics that you'll see on the test this week before we wrap up tonight? Thanks, April. Have a great night. Anything from you, Scotty? Okay, both of you have a great night. Thank you for being here, and look forward to a good week. Make sure and let me know if you get any questions or concerns, and good luck this week. Have a good night.